Good morning, everybody. Welcome to the Flow Show, Monday, 10th of February. Hope you all had a good weekend and ready to get stuck into markets again this week. Morning, Kay. How you doing?
Good morning, Ryan. Good morning, everybody. Yeah, I'm doing all right. The weekend was a bit short, I must say, but yeah, what has to be done has to be done.
Yep, exactly. Weekends are always too short when you enjoy them, particularly. So, as Dale would say, let's go to work. Bit of rate rising going on in Japan. Mizuho Bank has raised its LTP rate or long-term prime rate to 2.2% from 2%. This is a rate that had been stuck pretty low for quite some time, and as banks gained confidence that Japan's going to get back to some sort of normality and monetary policy wise and economic wise, this rate has been creeping up. It's now up to 2.2%. Quite a rise, 20 basis points on that one. According to the latest reports, Japanese investment trusts have bought a record amount of foreign stocks in January, but they weren't too happy with their holdings of Italian bonds because they sold a record amount of those in December. But they're still out investing quite heavily and buying a dip by the looks of things as things go. Coming on to a bit of data, and we've had Norwegian CPI out. Now, the Norges Bank have said that they're liking or looking to hike in March.
No, not
March.
probably not hike, Ryan.
Yeah, I just said cut. And this CPI data not exactly going their way for that. Core CPI up to 2.8%, CPI headline up to 2.3% from 2.2%. So yeah, it might be a closer thing than they expect unless we see a pullback in those inflation numbers going into the next meeting. Bank of England's Peel says there is an ongoing disinflation process happening in the UK, but we cannot declare the job done and need to maintain some restriction in interest rates to squeeze out price pressures. It says we need to be gradual and careful in easing. We should be optimistic that the upward blip in inflation this year won't lead to second round effects. And what he means by that is what Bailey and the MPC have said, that they expect inflation to maybe be high or tick up a bit into sometime into Q3, but it's not going to impact core inflation. Well, we'll wait and see about that. Not as if they have a good record in keeping inflation under control. The ECB released its latest neutral interest rate forecasts or levels. That's in the 1.75 to 2.25 range, which is largely unchanged since they last had a look at this back at the end of 2023. First question I've got on that, Kay, is maybe a little lower than what we expected, and it certainly, in the first instance, got the market thinking, well, there's still room for the ECB to keep up that basis.
Well, interesting is that the middle point of this is right where they want inflation to land or have inflation even a little bit below. So the best Europeans can expect on a day-to-day basis are zero interest rates if they succeed in what they are doing. I'm already happy that they didn't come up with a full 1% range. So the 1.75 to 2.25 is giving us something to think about, but it's still very vague. And then when you read through the report, first line says, but it is subject to a lot of uncertainty. Okay, I mean, right, nice one. I mean, anyone could have produced that. AI would certainly have produced a pretty similar report with so much uncertainty. We had the impact that I was expecting on a vague one like this, which is not a lot on the euro dollar. It would have been more interesting if they would have gone like a 0.25% lower or higher, even on the range. that would have given perhaps the market some food for thought. But I think it's just too vague, especially with when you look at the margins of error that there are in there. It's gigantic. There could be a margin of error of nearly 3% somewhere on one of the charts they showed. So
Yeah.
yeah, it's all up in the air, Ryan.
Yeah, it is, and we've been saying it. You know, these things, they don't really matter. Numbers don't really matter in the grand scheme of things. The only thing it matters to is certain parts of the market who are just going to use it as a target, as to whether they need to be hawkish or dovish. But numbers out, we can move on from that point. Anyway, ECB's Wojcik said that March and April are clearer. Are key for a clearer picture on the rate path, doing the old punting the ball into the latter months. It says market bets on 3 rate cuts are not unreasonable, and that UF tariffs wouldn't immediately trigger a 50 basis point cut. Now, while that may be the case, it does show you some of the thinking that big tariffs on the EU, Eurozone, could prompt a reaction in monetary policy, i.e. cuts. But so much for the inflation pressures that it's supposed to bring. Because if you get inflation, why would you cut rates? But who knows what these guys are thinking about. But just a little bit of an insight on how they might be thinking regarding tariffs from Mr. Trump. All right, coming back to Friday's data in the US, non-farm payrolls. Market had a little bit of a wobble when it saw the 143k pop out versus the estimated 175k. But that didn't last too long because, firstly, the prior 256 got revised up massively to 307,000. The unemployment rate dropped to 4%, was expected unchanged at 4.1, and that unemployment rate drop happened even while the participation rate went up to 62.6% by a pip. Wages as well went up 4.1%, was expected to drop a little bit further to 3.8%, and even the prior 3.9% got revised up to 4.1%. So overall, just looking at that, strong numbers when you look through the headline miss on expectations. Still inflationary pressures, still strong wage numbers, still healthy employment, jobs market. Took a while, but the dollar started making some ground afterwards. We also got the benchmark revisions. The level to March 2024 was revised down by 589,000. Expectations were around 600 to 800,000 in that revision, so it did better than that. The average monthly payrolls gain was revised down to 166,000 a month from 186,000 a month, so a little bit softer there, but doesn't really matter. Market doesn't care. We're still seeing decent jobs growth, still got an unemployment rate at 4% and wages still strong, and that's all that matters in the grand scheme of things. Canada, another gangbusters report from the 91,000 we got previously. We're only expecting 25,500, got 76,000. Gains in both full-time and part-time employment, although the balance was largely to the part-time employment category, but still a good number. Same thing here, participation rate went up even while the unemployment rate went down. So that was good news for the Bank of Canada. They may want to think about whether they need to continue cutting with those numbers. But, you know, end of the year, beginning of the new year can be a bit of a funky time. But usually you could see, make the case to see employment coming down if a lot of holiday hiring washes out. But these are pretty solid numbers, Kay.
Yep.
And even Canada not turning around. I mean, Canada can be quite volatile, but it's producing the goods at the moment.
It is. Yep, absolutely, Ryan. It is. They are good reports, both of them, because even if you look at the States, they are pretty good reports. Now, two things that I mentioned before. First one is that those data are still data from before Trump's inauguration in the US. The revisions being lower there, well, lower in the negative, less negative than which may have been expected. It now appears that those reports are well, you can't really trust BLS data. That is one thing, but then the household data are seemingly also, the models are seemingly also running on wrong data. So what do you want to believe? So that's why I said, like, let's get back to the headline numbers, but bearing in mind it's a report from right around or just before inauguration. So from next month on, those numbers may vary really greatly. But all else equal, good reports, both of them, Canada as well. Um, and sorry, and there we have then the same problem is that there's this tussle with tariffs ongoing, and how it may weigh on the Canadian exports to the US, how it may weigh on their GDP and things like that. So I mean, all those reports, they have a very temporary impact right now, but let's just keep them and keep them for comparison to what may about to happen on the next reports. The Canadian dollar behaved relatively well, but then you have the weekend news coming out, and it's giving back most of the gains. So that's where we are at now, and we still have got 3 years, 11 months, and a week and a half to go of the same.
Yeah. And yeah, that's going to continue as we well know. Yeah, it's for everything that's going on, you just can't fault the data. And it's, as you've been saying, this year coming into Trump and that, you're going to get the Trump headlines and the moves and news and everything. But when you don't get that, you fall back on the data because that continues to tick along. And that got the market going as well after that jobs report. Market pricing in its next cut still around June. That's been set since pretty much the FOMC. However, how many cuts we're going to get this year has been chopped. Now we're only down to one cut for the Fed this year. So the market getting is not hawkish, the Fed, but it's not dovish. Okay, it knows that the Fed's on hold now. June, July is when it's seeing the next potential cut coming. It's going to take a lot more to get it more hawkish than that. So really the risk moving forward is that data comes in softer rather than hotter because you're going to see a bigger reaction repricing the dovish side than you are probably going to see repricing on the hawkish side unless we get inflation blowing through the roof or something like that. So that's the position we're in for the dollar at the moment. So any misses on data probably going to get a bigger reaction in the market than any beats on the data. After that, we got the University of Michigan first reading of the January sentiment index. That dropped back. Let's get rid of that. Get rid of that. We saw that moving back into the 60s on all the numbers, 67.8 on the consumer sentiment number, expectations down, current conditions down. But then have a look at that. 1 year inflation expectations jumping a whole 100 basis points to 4.3%. Quite a significant move. I don't know if I've seen a move as big as that in this number. The 5 year number going up to 3.3%. Now, this might have been a bit more reflective of Mr. Trump getting in the hot seat. Now, remember, this survey is a telephone survey of some 500 people. So take it for what it is. But even so, we've seen these inflation expectation numbers, particularly in the consumer side, rising and rising and rising. And That's not to be ignored, despite what the Fed heads have been saying. Sorry, mate, was you saying something?
No, I
No?
wasn't.
Sorry.
Yes, as you say, the Trump effect, the communicating vases on sentiment versus inflation expectation is still very much there. Usually, when they expect a lower inflation, the sentiment goes up, and now with such a big jump in this short-term inflation expectation, it's logic that the numbers plummet somewhat. But we'll have to monitor that because the consumer is one that the Fed is obviously watching quite closely.
Yeah, exactly. Fed's Kashkari was one of the first out. He was talking about the jobs data, said the most important data today is the 4% unemployment rate. Says it's still a good labour market. The economy is strong and businesses are optimistic. We are in a good place to sit here until we get more information on the administration's policies. If we see good inflation data and the labour market stays strong, that would move me to supporting a further rate cut. He says we have a lot of confidence that housing inflation will help bring inflation down. Fed's Goolsbee says longer run market-based inflation expectations show the market believes the Fed will get inflation to target and believes it will take longer than the end of 2025 to reach their neutral rate. So some Fed heads, as I say, pointing to market expectations for inflation rather than consumer-based numbers. Fed's Kugler says considerable uncertainty is lingering over the impact of Trump policies. It's got him a little bit worried. He said the new data is consistent with a healthy US labour market. Here's a headline for you. NATO countries are apparently discussing sending troops to Greenland after Mr. Trump threatened to take over. The US is one of the founding members of NATO, so this is NATO on NATO action, apparently. Don't ask me how they're going to justify that one. That's not going to piss off Mr. Trump for sure. Further Trump dates. He increased duties on minor China goods on Friday, but delayed that until the Commerce Department has put in place adequate procedures to process all that. In his meeting with Japan's PM Ishida, he said he wants to end the trade deficit with Japan. Says he's not changed his mind on selling US steel, but will allow Japan to invest heavily in the company without taking a majority stake. He did mention that tariffs on Japan are an option to address the trade deficit. But then Japan is apparently going to soon begin importing new shipments of American LNG. And he approved nearly 1 billion of military sales to Japan this week. So Mr. Ishida obviously turned up with his checkbook to make things sweet. Overall, that meeting seemed to go all right, Kay. Market took it as Japan probably going to swerve the worst of tariffs or anything like that, and it's all going to be tickety-boo.
Yeah, they should. As expected, Ishida came with cash. You can invest but not buy American. That is also pretty much in line with the expectations. And the reaction that we saw this morning is probably one where the one I said, like, watch out for the double-edged sword in yen, because you have a positive effect on Japan likely escaping tariffs. That's a positive effect, with obviously the Bank of Japan in the background still pretty much on the path of hiking. And against that, we have all those big promises of investments, and those investments is usually equals at least in parts to buy the local currency for us. So that's the other side of the medal, which could in turn weigh a little bit on the yen. But the jury is out. We are turning around this level. We are seeing 150 points up and down moves in the dollar yen, like we usually see and when something is going on in the end. So people should still bear in mind that whatever happens, whatever headline comes out, the yen could still move like 1% pretty swiftly, and that is really the main message behind all of this. We have seen, and you were talking about the investments or divestments in equities and bonds. Last week, though, the bond moves were pretty much negative, the foreign bond moves. So we need to keep an eye on that, but because it may hint that the Japanese whales are bringing some money home. So I'd say watch those numbers, although those numbers are a few days delayed, obviously.
Yeah, thanks, mate. What has probably helped the yen pairs back up because they were doing well, swerving tariffs, is that Trump is apparently going to announce 25% tariffs on steel and aluminium today, and they will apply to all countries. Lots of countries getting on the phone to see if they can get around that. We've had Japan Chief Cabinet Secretary Hayashi saying he's aware of Trump's remarks on steel and ally tariffs and will respond appropriately after assessing the details and impact on our country. Apparently, Australian PM Albanese is got a call scheduled with Trump to speak about these tariffs and whether they can swerve them as well. Apparently, there was a headline out that apparently his new Musk department, Doge, has apparently may have found some fraud or irregularities in treasuries, which is potentially something we need to keep an eye on, depending on what all that means. It's a strange headline, but if there's some big shenanigans gone on in the US Treasury market, that is going to be big market moving news, depending on what it is. Even the rumours of what it might be about might be something to keep an eye on. So that's on the radar for headline shock in the early part of this week. The EU or the FT reported that the EU is apparently going to offer lower tariffs on US cars. So maybe they have decided to preempt any tariff moves by trying to play nicely with that. Russia, they're still saying that there's nothing concrete being put forward by the US or anyone else over peace talks. We remarked last week that they were sort of pushing the button, asking what's going on. You know, lots of talk about having conversations, but nothing's being put forward. So they're sort of continuing to push and see what's coming of that. Zelensky has said that he's probably open to a deal with the US on sharing minerals and whatnot. Obviously, if he can get some security details out of that and some solution to what's going on over there. So it's ongoing. Trump has said he is still earmarked to speak to Putin and China Xi, but when that's going to happen, we don't know. We don't know why there's such a hold up. That's that for that. Anything else, Kay?
No, move on. I think we've covered everything. It's just the uncertainty of dates and the uncertainty of how much and who. It's kind of funny that Japan was reacting to those steel and thing tariffs, because I mean they I don't think they export too much steel to the US. They would rather import some, no?
No idea. Obviously, got this Nippon Steel thing going over.
Yeah.
I don't know how it plays into that, or whether they're going to get swerved.
They're probably going to get like 40-45% or so, and then they'll strike a deal, I guess.
Yeah. But it's, just having that meeting last week, it might be something that we're seeing yen pairs reacting to this blanket tariffs, but then they might automatically have an exemption. So if you get that sort of headline, I'd expect yen to see some gains pretty quickly. So I think that's, again, something intraday risk that we potentially need to keep an eye on. Right, quick look at what's coming up this week. Not an overly busy calendar the week after NFP. Probably the highlight is going to be US CPI on Wednesday to kick us off. Inflation expected to stay unchanged around 2.9% on the headline, but another pip down on the core number. Obviously, that's going to reflect in Fed expectations, whatever that data is. We've got some PPI data from Japan on Wednesday too, with inflation doing well over there. More strong numbers are going to keep the pressure on the market, thinking about a sooner Bank of Japan cut than they are now. On Thursday, we get some data out of the UK, GDP data, industrial production data as well. Same for the Eurozone, PPI data from the US too. Then on Friday, we get the flash number for Q4 GDP from the Eurozone and some retail sales data from the US. So it's going to be probably the big watch of the week. But other than that, fairly quiet. So we're going to be looking at headlines for our main drivers this week, I think. Right, let's have a quick look. What's going? Yeah, go on, mate.
The one thing for people having sterling in position or so, tomorrow morning our time, I think Man is on the wires, and she voted for the surprise 50 bps cut. That may be one that people may want to pay attention to know what she says and why she went for that 50 bps. Because it was a pretty big 180 turnaround from her.
Yeah, very much so. Very much so. So that'd be worth a watch. Right, so yeah, into the yen, back above 152, trying to hold there for the moment. You can't keep a good yen pair down at the moment, as Kay said. Plenty of volatility still in these yen pairs. 1 month at the money vols in dollar yen at the moment, 10.44%. We did see a dip below 10% a week or so ago, but we're back right up again. We had this move under the 38.2 fib, which is a bit of a new one because it was previously drawn to there. Then I had to drag it up again to that level. So we got below there. Got a little bit of an area down towards this 150.80s. We just sort of nicked under the 151 pretty much, not too far under there. We've had a couple of those similar type moves previously. I think rallies potentially continue to get sold here for the foreseeable future. There's no real reason why we perhaps see a trend change, what we've seen since the beginning of the year. 153, 35, 50s, and then this level here is going to be the big one if we get back up there, because it was the break of that area that led to all that. Obviously, if you're watching this one, you keep an eye on what's going on in yields. There was a bit of a disconnect on Friday, and I don't know if it was just the Trump Ishiba thing, but over the data and a bit in the afternoon, we saw this bounce in yields, but dollar yen wasn't really following, not to the same sort of speeds it has been previously. Even now, these yields, 10-year yields back up at the 4% mark, but dollar yen isn't that far off the prior lows. This break, similar, came down to the 440, so that was similar to the dollar yen move, but this has been a strong bounce. We're not going back through that 4.5% mark. So it leads me to think if we don't, then it keeps a downside in play and then could affect the dollar. Who's that? Been that off. Where we've seen dollar strength mainly is in pairs like the euro. Now, a lot of people are looking at the gap down overnight, and I just want to point this out to you, okay? There were gaps in a lot of retail platforms overnight, okay, when we opened up Sunday, such as there, okay? There weren't gaps in the main market, the interbank market. The interbank market opens up, well, I was posting the opening numbers at 6:30 in the evening, 7 o'clock in the evening, okay? So the interbank opens up much earlier than retail markets. Retail markets open up at 10 o'clock. There were no gaps in the interbank market, okay? none more so than maybe the odd 5-6 pip gap that you always get. We had euro dollar moving, opening up, I think 103.28 or something, moved up to 103.43, I think was the high before it all crept down and we got the Trump headlines and whatnot. And then retail, when it opened, we were trading sub 103. So everyone's going, oh, big gap here. Okay, it's not. Okay, if markets had opened the same time as interbank, you would have just seen a normal move. So you've got to know the difference between a gap on a retail platform and a gap in the real market. Okay, there were no gaps. Okay, so anyone who likes trading gaps and what it does and whatever, all this does is just fuck up your moving averages. Okay, pretty much. So it just kicks them out of kilter. But don't get sucked into the narrative, oh, there's huge gaps appearing just because retail isn't the market. Okay, the interbank is the market. It's tier 1 liquidity. You'll be lucky if some of this is tier 3 liquidity. At best, maybe the odd bit of tier 2 in that. Retail is very low down the liquidity ladder in terms of that. But anyway, we've had a bit of recovery. We're back to Friday levels. Euro dollar doing the old hard work again. Overnight, we did get close to this support zone down here, down in the 50s, 70s. Couldn't quite get there. We've had a bounce. We're now coming up to test the underside of this zone again. We need to get above there. It's got to do the work again. Then we've got to see this sort of move, maybe it holding before we then think about pushing higher. I'm going to bore everybody. I'm coming back to the same old, same old. We are not yet breaking this trend. This is still a bearish trend, okay? The only thing bullish about it is that it stopped making lows or new lows. And we're seeing a bit of divergence between some of the other pairs. Aussie dollar, that made a new low last week. Kiwi, that made a new low last week. Yeah, it was a bit of a shock low. A bit of a headline low. This was a proper gap because we saw proper gaps happening in the interbank as well. It has recovered, but the fact it made a new low makes these sort of the weak links out of some of the others. Cable, similar, couldn't even get down to the prior low down here. So the trends are still going, but they've stopped going down. So it's a bit more balanced. It leads to potential sideways action. Until we're getting up above 125s again in cable, we ain't going to 127, 128 or wherever. Same with euro dollar. Unless we're getting above here, this is my key area. If we're moving above here, then you can probably think about a lot more. But you still got a ton of stuff above it, 106s to get through. But get above and start holding above 105.30s, then you're going to be thinking about maybe heading back towards 108s, something like that. Until then, the downside, further downside is still possible. But I think we're probably going to see a lot of ranging going on here at the moment. Just a quick one I'm looking at, as always, because I'm still short in this one, and I've had a little scalp again up here. We're testing the 111 in Aussie Kiwi, so I'm having a little tight one there just to pay for some costs and maybe fold a bit more into my shorts if it manages to hold here again. If it doesn't, we're probably going to see 111 40s, 50s up around here, if not up towards those highs again. But we'll see what's driving that. Got over a week until we get the next RBA and RBNZ meetings. And they're going to be, particularly for the RBA, is going to be an interesting one because a lot of the market looking for a cut next week at the RBA. And I don't know, I'm not so sure one might be coming, but we shall see. Okay, I'm going to punch it over to you, mate.
Sure, mate. I'm finding it quite strange actually on this Aussie Kiwi because I mean Australia has been kind of in the loop and a bit of a target, but I haven't seen anything on New Zealand, and yet Aussie Kiwi is pushing higher. So what's the story there? Is it like the expectations for RBNZ to cut 50, or I'm a little in doubt about why it's up here. I don't have a position. But I don't really know why it's up here, this Aussie Kiwi. That's a good. Mm.
I mean, you can swap labels on these two, and they look exactly the same.
Yeah, they look the same. Yeah, yeah. We're talking about like, but still, I mean, Aussie Kiwi was at 110 a week or a week and a half ago, and now we're at 111. It's a 1% move. I don't know where that comes from, to be honest.
Yeah, no, neither do I. Uh,
Mm.
Obviously, I wish it was the other way, but it's not, and that's the way it
Yeah.
works.
Mm.
Right, let me sling it over,
Bang
mate.
it over. Bang it over. Yeah, let's go the traditional tour first. Gold. Are we at 3K yet? Nah, not yet. There's a bit of work to be done, but my expectations still are seemingly correct. That the more we have uncertainty on tariffs, etc., the better it is for gold, and has very little to do with interest rates right now, but more hedging. If you are and I'm just going to take them as an example. If you are a Chinese bank or investor, and you're based in Chinese yuan, are you hedging something against your risk that something may happen to the Chinese yuan? I think the answer is clearly yes. So now we're pushing through on gold. We are slowly but surely approaching the 3K. There is a bit of a channel here. It's always tough to know, and it's only really a 2 point line. So that comes in around 29.20, which may be. Um, Maybe a bit of a break for the move right now. We also need to see what the Americans want to do with it. But every time we think there is a bit of a pause or a bit of a setback coming, we are getting that 30, 40, $50 setback, as we can see on the shorter end. We're always getting those setbacks, always getting those setbacks, always getting the setbacks. And what happens afterwards? It does a fresh high. So I think don't change tack unless we have to, okay? Unless we start to break below some of those support levels and hold below, it's likely going to continue still for now. I can't really find a decent reason to counter trade it unless there is one very big dollar wave on the horizon. But is it on the horizon? And that's the next interesting question, because we have seen now another set of tariffs, another set of threats coming into the market, but the moves have been smaller pro dollar, right? So Ryan was already saying we are not really holding highs in the dollar for now, and we are seeing it again. We've done that low in euro dollar. Yeah, depending on whether you're a retailer or a bank trader, you will see different lows. But anyway, we were under 103. We're now trading 103.35, even if Germany has been threatened, for instance. But the dollar is starting to lose its shine on every hinted tariffs, and it is just something that I'm noted this morning. Especially on stuff like this, for instance, this Aussie dollar, I thought that we would stay lower. And I'm actually a bit long, as the people in the room know. My stops are somewhere below this line here, but I thought that there was a fair chance for me getting stopped on those moves, especially with Australia being targeted and feeling targeted as well. And yet we are coming back relatively easy. So to me, that does give me the impression that perhaps the market is thinking, well, hang on a minute, maybe it's not that good for the US either. And the dollar is not keeping the highs right now. So that is perhaps an interesting development as well. It did already similar kind of moves, but we have to look at it in the global scheme of things. Is the dollar really going to outshine everything else if we are going into tariffs, or is the market right in saying that, well, maybe not? I think a lot of those moves as well had been driven by lower equity markets. They are relatively stable, but you're seeing a bid in the dollar coming in when equity markets go a little bit lower, but then that bid is going. And Aussie is a reflection of this. Now, we are not out of the woods by no means. 62.80, 63, the figure still has to go. 63 and a quarter, gateway to higher levels for the Aussie. For as long as that doesn't happen, we are probably going to trade around here a bit in the range. But if we get through 63 and a quarter, I think this could potentially have a look higher, perhaps up in the 64 zone. And why not? Because in general, the dollar is a bit more on the defensive. Kiwi, similar kind of thing, but not jumping as much as the Aussie, as the Aussie Kiwi is showing. Yet we are sort of holding this 60, 56, 30, 40 zone. This is where I'm going to monitor this. But again, we need to get above this 56.80, 57 zone to get going again on the Kiwi. And for the time being, it's a very anemic bounce. It looks an okay bounce, but it's only about 30 pips or so. So for the time being, respect that range. I'd say 60, 56, 30, 56, 57, the figure basically, and see what happens if we get outside of there. Cable, yeah, what Ryan was already mentioning, we have gone down, virtually closing that prior move down here, not far away. I think it's starting to be an interesting intermediate level here. Before the bigger ones down here, this 123, call it 65.75. It stopped there last time and stopped again today. Interesting enough, I would say. Euro sterling, not too much to say. It's still the uncertainty about European tariffs, perhaps. But I've covered some more of my shorts from where was it? From here somewhere the other day. Yeah, from here. I covered some more of my shorts that I'm only keeping a very small left. If we get back above 83.35 or so, I'm gone. It's something that, especially with man up tomorrow, and then the data in the UK this week, it could be that sterling has perhaps ran its course versus the euro, at least for a while, and we settled down in this traffic area. I think down to 82.80. If I get it down there, I'll be a very happy man to take profit, even though the overall picture is still a negative one. We have to look at the potential, and the potential, and there is a few risks in for sterling coming up this week, yeah, with man tomorrow and then the data out. So, what else? Not really seeing too much else to talk about. Wider picture in dollar Swiss. It's holding, okay? It's holding around 90. That was a good support. We're bouncing top side on the wider 92. Okay, 90.92. This is the range that you need to know for the Swiss going forward. Breaks out of that 90.92 range. I think we can see a deeper move. Okay, it could be that this is a bit of a double topish, but and if we break 90, there could be a too big figure move down to 88 perhaps. But for the time being, it does bounce. Risk is not getting hammered completely. Yes, we have come down on the euro Swiss, but the euro has its own problems. But we do stabilize. Swiss is not really keeping the upward momentum for longer than a few sessions. And that's a bit the global theme that we are seeing now, is that you're getting those moves and then we reassess. Okay, so the only ones that really keep the moves are gold. That is one. I also think overall that the oils are still looking very average, but okay, we are it's a daily, yeah. We are holding those low 70s that people are watching, but in the global scheme of things, they are still pretty low and really looking a bit risky to go for a retest of those mid 60s at some stage for WTI at least. So those are gold and oil's two major themes. But if you trade FX, you still need to be flexible in what you do. Yeah, you covered the yen, I think, Ryan. I think we're still going to find rally sellers until something changes, perhaps for the Bank of Japan or on tariffs. But until then, I think that on serious bounces of yen pairs, we may find still rally sellers there, and that's going to be it for me for today, Ryan. Back over to you, mate.
Thank you very much, sir. Good stuff as always. And yeah, that's hopefully got everyone set up for the week. We know what we're looking for. We know what we're dealing with, apart from the stuff we don't know is coming, like any Trump headlines. Have a great week, everybody. Make bundles of pips, and we'll see you all later on the Face Show or tomorrow morning. Have a good one.